from proactinvest.net with another video session here of charts of the week for the end of January, January 31st. Okay, so let's get into it. All right, first of all, the disclaimer. The presentation is not a solicitation or offer to buy securities or participate in an investment program. Second, the principal, that being me, of proactinvest.net, may have positions in the securities discussed in this presentation. That's because I wouldn't recommend a position that I wouldn't personally own. But I may or may not have positions in all of the ones discussed. Trading or investing in stocks, bonds, ETFs, options, futures, mutual funds involves risk, and you should try your best to understand these risks by researching and comparing them across the asset classes and security types. And I'll be going into how to analyze and compare these, evaluate these risks in subsequent educational tutorials on this site. Invest.net recommends that you scale down your allocations to riskier securities until you are comfortable with the overall risk of your portfolio. Trade as little as you can in riskier securities until you understand the way they gyrate and can affect your overall portfolio. If you're not experienced managing investment portfolios, we recommend that you meet with an experienced fund manager with a proven track record. It's better to work with investors who are experienced in this business. The key important points to cover here. First of all, what's on tap? Today, at the end of close, Amazon will report earnings. We also got the Case-Schiller index out today, this morning, and consumer confidence. Now the Case-Schiller number did come out this morning, and it showed a drop in home prices across the 10-city and 20-city index for America. A drop of about 3.6 to 3.7%. And that is a cumulative drop of about 37% since 2006 for real estate prices in America. Having said that, we think that the real estate sector in general looks interesting. The home construction sector is actually forming a base. If we take a look at it right here, this is the Dow Jones Wilshire International Real Estate Fund. Ticker is RWX. And as we can see here, it's forming a double bottom on a positively sloped support line, trend line. While it may not be an outright buy right now, it's definitely something to keep an eye on because it's quite possible that this RWX will pop up above this resistance level, this moving average resistance around 36, 37. And once it does, this will become an outright buy signal. But we are watching this development as we speak. Another development to keep an eye on in terms of the news is Facebook will be filing for an IPO this Wednesday. When the actual IPO takes place is still to be determined, but they're filing. And also labor figures this Friday, the employment stats from the government. That should be something to keep an eye on this Friday. Okay, as I mentioned last week, Dow is approaching 13,000 resistance level. Let's take a look at the chart real quick on that. Okay, as we can see, it's backing off the highs here, the recent highs, and it's sort of pulling into this wedge formation. The question is it going to roll over here, or is it going to still make a valiant effort to scrape the 13,000 area? At the moment, our indicators show that we're still in a positive mode, and we wouldn't be shorting here at the moment. So we're still giving it the benefit of the doubt. Some other important news, of course, we have the Greece and the Euro worries. That's a Forex-related question, but it also rubs off on the stock markets. The majority of S&P companies had beaten expectations. Something like over 60% of the companies reporting actually beat earnings expectations, so that's a plus long term. Record low inflows into stocks by individual investors, as recorded by such companies as Trim Tabs. This, to me, is a contrarian long-term buy signal. So back in 2000 at the tech bubble peak, everybody and everyone at parties and friends, used to talk about how great they were at picking tech stocks and everything. And everybody was a stock genius. Well, this data right here is the actual opposite, or perfect opposite or inverse of that hubris that we saw in and bravado and overconfidence of 2000. Right now, individual investors are like Roberto Duran against the ropes in a boxing ring, saying no mas, no mas. I've had it with individual stocks and stocks in general. Get me out. So individual investors are avoiding stocks like the plague. We view this as a long-term contrarian buy signal. Another interesting development to keep an eye on here is this issue of Li-Fi to replace Wi-Fi. As you know, Wi-Fi is like the radio signals between your router boxes and your modems and your laptops. Li-Fi is a light-based signal as opposed to radio signal, which transfers information much faster. And this is a semiconductor chip-generated light signal, and it's highly likely that Li-Fi will be replacing Wi-Fi, not necessarily completely, but to a large extent for rapid transfer of information, especially inside of offices. We view this as a plus for semiconductors long term. And if we take a look at the chart once again, let's review the SMH. Okay, as you can see on a long-term chart, it's following the tech burst of 2000. It's been sort of basing out here for many years, and we've got a positively sloped bottom formation here. So we think that this could easily test a 38 area over the next few weeks. Something to keep an eye on here, but we favor this sector, and positive mo here, positive momentum also, so we could easily go up to the 38-40 area. Another development to keep an eye on is the Chinese central bank has entered a selective easing mode, and that they'll be ready to add more liquidity if necessary. So it looks like China's going to be there to add liquidity going forward. This is also in line with other BRIC countries like India and Brazil, who have also are leaning more towards monetary easing. And so this in general we view this as a positive development for global stock markets in general, and also the emerging markets. So we still think EEM looks attractive here. Let's take a look at the chart quickly. As you can see, this chart also has a positively sloped support trend line, and but unlike SMH, it's still kind of like under a resistance level here of 43.5. But as you see, EEM is still under a 43 resistance level area, and once it breaks through that, it'll probably head higher to the 47 area. But we think that's likely. We don't like the fact that there's still some negative momentum here, but that can easily be overcome once we break through the 43 area. We don't have time to go over everything here. If you are a subscriber to the service, you'll get the full presentation. This is a quick wrap-up of the main points going forward for this week. We saw the muni market, a municipal bond market, on a tear over the past 2 weeks. But the question is, do you want to buy them up here in the clouds? Let's take a look at the chart quickly on that. MUB is the ETF for, as you can see, MUB is just broken out into the clouds. We think that at 112.60, that's a little bit too pricey for us to get involved. We would prefer if it were back around the 100 par area, so then we'd be interested in picking it up, but I don't think we want to touch it here. So what does look interesting in the bond land here? Well, we still like the emerging market debt, and that's in line with what we said about the emerging market stock index. The JP Morgan Emerging Market Bond Fund, EMB, still looks like it's attractive here. And don't forget that EMB also pays a dividend at the end of the month. Metals are kind of stuck in a range, and crude oil is also in a range, not really doing much. We'll take a quick review of this chart again. So the ETF for gold is GLD. If we look at the weekly chart, as you can see, it's kind of like, well, it could go a little higher here with the monetary easing by the global central banks. Every central bank in the world today is adding money to the system. So, I mean, that's an argument to buy gold here. It probably will continue to go higher at 172. As you can see, silver is really stuck in a range. It's not really as exciting. USO is really just flatlining here. If you look at the long-term chart, this is a monthly chart. You can see we're still going sideways. So not terribly exciting in the energies or in the metals. Look at the agriculturals are also pretty much going nowhere. Another key issue to watch is the development here in the currencies and foreign exchange. We've got the euro bouncing off the 126 level, as we mentioned last week. This is not a currency that you want to short here. I don't think this formation is something I would short at this point. Would I buy it? Well, that's another question altogether. We do have negative momentum here. We're still under the moving averages and the resistance. If you look at the weekly chart, we're we bounced off of this key support level. We hit this resistance area 132, and we're backing down from it a little bit. But again, it's quite possible that it'll roll down and do the double bottom here, a retest of the 126 area. We have negative momentum as well. Dollar euro could roll over here and do a retest of the support level, but it's something that I just wouldn't short, given, outright, be a crazy short on this, because it's making a valiant effort to bounce off of this support level, and this formation to me is not something that I would short personally. Okay, before we go, let's take a look at SPY. As we saw with the Dow Jones, it sort of tested this resistance line, and we're backing off of it. But notice that we're struggling to keep above this 200 linear regression area, and we still have positive momentum. An important level to keep in mind here with the S&P 500 is this support range right in here, this 130 area. This area right here represents an intersection of the 100 linear regression, the white line, which as we see is positively sloped, and the 22 XMA, which is on the daily chart. This intersection is about the 130 area. So that's the area that we'll be focusing on. Is the S&P going to break that level? If it does, we may want to go short the market and take a look at treasuries at that point. But, I don't think I would play treasuries here on the upside. If you take a look at this chart, the 5-year treasury, we're at 0.071% yield. That's the lowest it's been since the 1930s, okay, since the Great Depression. With an inflation rate, average inflation rate of 3.1% in the United States, why would anyone buy a 5-year treasury? It's just money thrown away. So I believe that you have to be very cautious when you consider buying treasuries at this point. The only time I would consider buying treasuries would be for defensive purposes. If the spider were to break this 130 area, 129.65 area, at that point I would seriously consider going back into treasuries for a defensive trade, because then it's quite likely that it will move higher towards this area. But until then, I'm going to stay away from treasuries and give stocks the benefit of the doubt. Okay, quick review of the swing indicators for the IWM. Which is our litmus test for the overall direction of the stock market, U.S. stock. That we're slightly positive here. We're still in positive territory, although we've come off the strength that we saw over the recent days. So, but we're still hanging in there for now. The longer term swing models for the major benchmark indices are also still green. And we're favoring, as we mentioned, technology. We also like MIDI. Well, that does it for this week's Charts of the Week. I hope you enjoyed it. I'd like to ask you if you could share this with your friends. Like this video if you could on YouTube when you see it, and spread the word around. Thanks for listening, and have a great week.